Okay, guys, it's 12. Are we ready? Let's get started.
Let's
I
get
just want to
going.
say thank you so much for everybody for coming. And if you got in here early, thank you for listening to our banter before we got started. We designed this 3-part webinar series to cover sort of all the essential information you need to know when you're buying a business. Today is our first one, and it's about valuation. So we're going to talk about that. But we also have a financing one and a due diligence one. So if you haven't registered for those ones, please take the time to do so. I am excited to welcome our 2 speakers, which some of you were just listening to. We have Keith MacKenzie. He is our founder and managing partner at Chinook Business Advisory. Chinook is a full-service business brokerage with offices in Victoria, Nanaimo, and Comox, and we serve clients all over Western Canada. While our primary focus is sort of assisting the sell side, we do play a key role in helping the buyers. So quite often when there's a business for sale, we'll guide them through financing, getting through all the hurdles and sort of meeting in the middle to make sure everybody's happy with the acquisition. And we have Liz McCrae. She is the co-founder of Village Wealth, and Village Wealth is a Canadian-based acquisition management platform. Their software and programming supports business buyers by evaluating and offering on businesses for sale and navigate the whole process from the buy side. So their specialty is really to assist buyers. It's what they do. It's their whole focus. So they help them, with financing issues and anything that may come up that they may need guidance to get to the finish line. So that said, thank you to our 2 speakers, and I will get the presentation started.
All right. Thanks very much, Brianne. Looking forward to getting going.
All right. Can everybody see this? You guys got it? Okay, great.
You got it.
Yeah. All right, Keith, if you want to get started.
All right. So really the first, it's a 3-part series that Liz and I are going to do here for the next few weeks. And we wanted to start out speaking to buyers about business valuation, and specifically from sort of a buy-side point of view and from a broker point of view. So giving you some insights on how we arrive at value as business brokers. We use something called a most probable selling price. So what that does is it takes into account a number of different valuation methods, and the end result of that is a number that we think is justified and defensible, and we think that will make it through financing and allow you to do a deal at the price that we put forward. Now, to be fair, I will say that not all buyers appreciate the asking price that we put on our businesses, so we'll be interested to get some buy-side feedback on how we price these things. And maybe Liz, from your point of view as an ex-broker and as a buy-side rep now, you could sort of speak to what you're seeing out there when people like myself are putting out prices on businesses. Are we, as one of the tweets earlier today, are we lying to our sellers? Are we giving them sort of overpriced? Are we overpricing their businesses in hopes for a higher price than is justified? What do you think about that?
I think Chinook is a little bit different at times than many other brokers out there. The multiples that I've seen you guys apply to the businesses seem very reasonable and, in the realm of realistic expectations from what I've seen on many of your listings. So I think, in many cases, there are many brokers or advisors that do start high. And this being an unregulated space, that's just the nature of what happens. So as a buyer, it's very important to understand, what is fair market or what is appropriate for us, the right size, the size of business that you're looking at, but also the industry that you're looking at. And there's a lot of gray area. So looking forward to jumping into all of this content today.
Sorry, I just want to interject for 1 second. I forgot to mention something important. We really want this to be an open discussion and for everybody to be able to ask questions and come on and join in the conversation. So if you do have something that you would like to ask, please just use the little raise your hand icon at the bottom, and then we'll let you jump in, and you can either just do your mic or you can do your camera, whatever you're comfortable with. But please join in and ask questions as we go along. Okay, thanks.
Thank you. So from the from a business valuation perspective, there's sort of three business valuation approaches that just about everybody that does business valuation uses. The first is an asset-based valuation, the second is an income-based valuation, the third is a market-based valuation. And we'll dive into each one a little more as we in the next page or so. Each one has its own sort of place in the business valuation universe or ecosystem. So we'll start with asset-based valuations, which I think most of the folks that are looking at buying a business aren't all that interested in. Typically, an asset-based valuation is used when the value of the underlying assets of the business exceeds the cash flow value of the business. And what that means, and I can using an example, a current example that we have that we're working with right now, we've got an equipment rental company that's got assets. The fair market value of the assets is about $8 million. The asking price for the business is about $8 million. So there's not a bunch of inherent goodwill in a business like that. Business makes about sort of around $2 million a year, so it's a 4x multiple. Hard to get a higher multiple than that in that particular space. So in that asset-based valuation, we just took all of the assets that the company had, applied a fair market value to each of them, summed them all up, and that became the price that we went out to market with. So there's a couple of, I don't know, Liz, do you use asset-based valuation much when you're working with buyers?
No, not typically, but it can support, like in that example, it can support the cash flow valuation. If the asset value is high or close, like it's less risky for a buyer, because if the business fails for whatever reason, then you can liquidate the assets, and it's additional security that the banks appreciate from that perspective. So it does play a factor, but as far as just a straight asset valuation, I remember last year we heard of a story, and sellers can perceive asset value differently. And I'm sure you do lots of realistic expectation setting, Keith, with people that you're dealing with when you have those first conversations with business owners and you're setting those value expectations. I know sometimes, and many buyers are having direct conversations with business owners too. And I've seen it many times where, business owners feel that, well, it should be a cash flow multiple and then my asset value. I'm going to add them together, right? Or, what do you mean? What do you mean my cash flow value is less than my asset value? Like, what do you mean by that? So there's certainly lots of setting expectations on the sell side that happens more than the buy side, I feel.
I think before you flip through to the next one, I think from a buyer's perspective, the asset, it is underutilized, I would say, from most buyers. But the way I would think about the value of the underlying assets in a business, so is it's kind of your get out of jail free card or your get out of jail card. So if you're buying a business for $2 million and there's $1.5 million of assets in that business, once you have an equity plus loan repayment of $500,000, you're basically free and clear. If the worst case happens, you've got underlying value, you've got $1.5 million of assets that you could sell off and recoup your investment and pay back your bank. So I think I think a lot of buyers are probably coming from Alberta, where there is a lot more physical assets to businesses. Where in our jurisdiction, most of the businesses that we sell are cash flow based businesses, service based businesses, where the underlying asset value is pretty small in comparison to the purchase price. Lots of goodwill. So in those situations, the people that are buying businesses like that are accepting sometimes more risk in terms of loan default, but on the other side of that equation, they're not having to buy and replace new assets, or your maintenance CapEx is reduced significantly. So there's pluses and minuses to everything. Big asset, lots of business buyers hate heavy asset-based businesses, but there's for the people that are comfortable in that in buying stuff and maintaining things, then there's good opportunities to be had, because they tend to be priced a little bit lower in general, I would say. You see that sort of if you've got if you've got a big maintenance CapEx, the business buyers in general seem to want to devalue that business more so than they would on sort of a software company that's got almost no CapEx.
They will want to see it modeled in. They will want to see, an allocation for CapEx on an annual go forward basis. So if the broker hasn't factored it in, then they're likely going to add a normalization that hadn't previously been incorporated. So it can impact how they would offer.
And on that modeling note, is that something that Village Wealth does with their buy side clients? Is work on a 2-year, 3-year, 5-year plan?
Yeah, it is. We would look at the historical, and then we look, because it's one of the things that the lenders ask for is a 2 to 3 year forecast looking forward. So we would look at, based on how your debt servicing is, your loan payments to the bank and the seller, and however you've structured it, and all those sources and uses of funds, and we model out like the term of the loan. So if it's a 5-year loan, and we look at all the payments and all the expenses going forward for the buyer and how that's going to model out to make sure, can you actually afford this business, and does it make sense for you? Because, someone who, and sometimes it can come down to, how much is a buyer needing to pay themselves. So, one buyer might need to pay themselves a higher living wage than another, and that changes the formula. So each buyer would look at their own valuation from their own perspective a little bit differently, and how they're going to offer on that company.
And in that, when you're going forward with that modeling, do you do some scenario analysis as well? If I grow it by 5% per year, maybe there's an excess marketing, or maybe there's no marketing budget. So, adding a line in for marketing, or reducing the accounting line, or reducing the professional services line, to sort of get a really sort of a true idea of what the business is going to do for the new owner versus what it did for the last owner?
Yeah, exactly. So we would take your normalized EBITDA figure, and we would look at that and what you've normalized, and go, okay, in your buyer, John or Joe, what do you need to make this work? Or what are you anticipating changing? Or what is your growth strategy here? Because we model that annual growth rate, we model that CapEx, and what hasn't been done in the business and what you plan to do in the business. And does this make sense? Do you have enough, capital or cash flow on a go forward basis to run the business as you feel it needs to be run under your ownership? So it's all a function of our software in Village Wealth that gets modeled out.
Excellent. Yeah, I think that's the way to do it, because at the end of the day, there was an old saying in our business that people pay for yesterday and buy for tomorrow. Mm-hmm. So understanding your tomorrow when you're building these things out, I think is probably the single most important factor when you're looking at purchasing a company. Is what's it going to do for you? How's it going to change your life? What am I going to be able to do with this sort of foundation that somebody else has built?
Yep. And getting really clear on, what are you as a buyer, what are your objectives? What are your long-term intentions with this company? Where do you want to see it go? Because, in the beginning, having sightline on those kind of more longer term ambitions will help you make the right choice about whether a business is actually a fit for you or not.
Yeah, 100% agreed with that. Let's go the next valuation model that is used by just about everybody is the income-based valuation. That really what it is how much profit does this particular company make? You can use capitalized cash flow, discounted cash flow, a bunch of different sort of financial models to get to a number using this valuation method. CBVs use this a lot. In the business brokerage world, we don't use this very often, I would say. I've been doing this for about 15 years. I used to use discounted cash flow as part of my valuation. It tends to overvalue most businesses in my view. I think it's great from a buy side is to use this for your future projections and how it's going to work. But from a sell side, I've yet to see a buyer sort of accept a discounted cash flow analysis as a justifiable valuation model, because the betas are super hard to to sort of bring down, like, you have a home service business and the beta is Home Depot or something like that. Like, how do you discount a $400 billion company to meet a $2 million company? I don't find that it's a super effective tool to use from an initial valuation perspective, but I think going forward, it probably offers a fair bit to the buy side.
Yeah, I think it's certainly a consideration, and it's a model worth running when understanding how you're going to value a business. But yeah, I've seen CVVs give an analysis on companies that are in the small business space, but they're benchmarking them with mid-market multiples, and a lot of the data that discounted cash flow models run off of is larger company data, and it's just different in the small business space. So looking at the rate of return, it's related to the multiple at the end of the day. How many years into the future do you want to pay for this business? Bigger businesses capture a higher multiple because they're lower risk, and so the discounted cash flow method will output that as well. And then the multiple that's applied to the income-based valuation is also, a factor of risk. How risky is the business? Well, small businesses are higher risk in nature, so they capture a lower multiple, bigger opportunity for return. So within a shorter period of time because of the risk factor. So all taken into consideration, but at the end of the day, it's how much how much is someone willing to pay, and how much is a seller willing to receive?
Yeah, that's definitely get to that part of it. I think that's ultimately the conclusion of all of this is that the market decides at the end of the day. But some foreshadowing. There we go. And the last one is the one that I think is the one that is most common in the business brokerage space to determine a value for any particular business, is to use market comps. And market comps come from a variety of different places. The one that I think most people are most familiar with would be BVR or DealStats. They've got a database of about, I want to say 40,000 or maybe 70,000. I can't remember, but they have a lot of data, and that data comes from business brokers essentially. So on sold deals. So every time we sell a deal, we put that underlying data into DealStats, and then DealStats sort of aggregates all that data. So if you're looking at buying like an HVAC company, you can go into DealStats, choose the right NAICS code, and that'll give you sort of a range of what the companies have sold for over time. One thing I do find about the market-based valuation is that it essentially, in my view anyway, a market-based valuation is sort of a proxy for industry risk for the most part. So you're looking at like 100 businesses in one sector. They on average trade for 3.2 times EBITDA or 4.3 times EBITDA, whatever that is. And that applies across that whole industry or that whole code. So I think from the business broker perspective is that we use that industry data to say that our business, the businesses that we're representing, will on average trade for 4.2 or 4.3 times, but the individual business risk, I think, actually has a greater bearing on the actual price of the business than the industry risk as a whole. And so and for the most part, I will say that most small businesses trade between 3 and 5 times EBITDA in general. So the industry risk isn't that predominant for most businesses. Restaurants trade for less; they're more risky. Everybody kind of knows that. But where it is more useful is on very specific industries that trade for much higher multiples. So Liz and I talked about this the other day, where, if you're looking at buying an insurance brokerage, the market-based valuation will generally tend to be like 10 to 12 times earnings or something like that. Veterinary clinics are another one, dental clinics. And all of those ones trade at much higher multiples, which make sort of your average financial buyer have a much harder time with those deals. Are you guys seeing any of those sort of outlying industries in your work so far, Liz?
No, those ones I find, the insurance, dental, vet, they'll trade in small circles, and you almost have to be in the club now. Coming in and trying to penetrate those industries, if you're not already in it, is very challenging. But we are seeing people in those sectors that, we're seeing companies that are in those sectors that don't like what's happening in their industry. They don't like that everything's getting eaten up, and how are the the employees and the companies being treated after they've been rolled up. So there are some things that are shaking up in those spaces. But as far as the small business space, yeah, I would concur. We're seeing kind of the 3.5 to 5 times EBITDA is the norm. Like 5 would be on the higher end, where companies would have recurring revenue, or maybe a SaaS component, or their EBITDA is healthier, so they're more stable, in which case we often see that businesses are capturing that multiple when there's more demand, so it's more competitive, where you guys have gotten attention from a great group of buyers, and it just goes that way because there's more tension. But yeah, most of what we're seeing is on the smaller side still. And I think one thing that frustrates buyers when, is where are you applying this multiple? What are you applying it to? What we see more of is that, a broker is trying to apply a 3.5 to 5 time multiple to SDE and not EBITDA. And that can be very confusing for a first-time buyer, because you remove the owner's salary and you allocate that into the expenses. And now the multiple looks like it's 6 to 8 on a small business. And the valuation expectations are not meet. They're just not meeting. And that's where we see a business have struggled to sell.
Yeah, I think, to speak to that, it's an interesting problem, because we work in the smaller business space at times. So, businesses that are worth maybe $200,000 or $300,000, they're basically buy yourself a job type of businesses. And so we apply, and they're not really built for financial buyers. They're not an investable company. And so we try and make that clear when we're doing our advertising. This isn't an investable company. This is buying yourself a job. So if you're a healthcare worker making $65,000 a year doing, in a support role, and you want to buy yourself a job to own a cleaning company, the owner of that cleaning company is making $120,000 a year. And so the price on that might be, say, $200,000. Are you willing to invest $200,000 to go from a $65,000 salary to a $120,000 salary? So that's the thinking behind the seller's discretionary earnings multiples. But to conflate them or confuse them with an EBITDA multiple is wrong and untenable. So in that particular instance of that cleaning company, if the owner's making $120,000 and a general manager might cost $80,000 to replace that person, so now we've got a $30,000 EBITDA there, and the price is $200,000. From an investment point of view, that's insane. Like, nobody would pay that. But we sell in that sort of category all the time, because people recognize that I'm not investing that money. I'm buying myself a bigger opportunity.
Yeah.
So I don't know how that translates to your buyers, but that's the thinking behind that.
Well, and I think you guys do a really good job of separating and disclosing, like, here's the SDE and here's the EBITDA. I've seen in some of your listings you have both, which is really nice. And you guys have a more transparent way of presenting it. In some cases, we see it more when it's almost hidden, like unknown, like they're presenting it as EBITDA, but then when you remodel and analyze where the normalizations have been done, that the owner's salary it's being presented inaccurately. And then to your point, of the $200,000 business where the owner is drawing $120K, it really comes down to the buyer's personal position too. Does that make sense for them? Can they still reach their personal goals and income needs on that valuation with that company doing that role in the company?
Exactly. And that's one of and those are the ones that you are buying yourself a job. And luckily, not most banks probably won't support that type of a purchase, but the BDC seems to, be able to jump in there and understand that that's what's happening. And so as long as they can debt service and provide them their own living wage, the BDC will support deals like that.
Yeah, BDC is really great for the under 500,000 ones. And then also, I know we're going to get into financing next week too, but there's some other less known programs too, like Futurpreneur is for, people who are under 39 and they have lending programs. And then if you're in rural, Community Futures does lending up to like 150K. So there's some smaller, more rural or lesser known lenders that can lend in acquisitions for those smaller kind of buy yourself a job.
Yeah, and I think there's a women's entrepreneurial program that's available as well for female buyers.
We have a couple raised hands. I just got a little notification. Are you guys okay if I?
Yeah, let's do it.
Shoot.
All right, Paul, I'm going to let you in. Let me know if you have any issues.
I think Paul's still on mute. There we go.
Okay,
Yeah, sorry. Hi, guys.
Hi, Paul.
Hey. Thank you very much for organizing this webinar. It's very useful, and I was looking for a chance to speak with you guys because I've been with Chinook for quite a long time and just monitoring what you guys doing in the market, and I'm one of your most loyal potential partners, customers. I mean, I'm a buyer, so.
Oh, thanks very much, Paul.
Yeah. So a quick question for you. The framework I'm currently have in my head, and what I'm talking about, how to do company valuation based on SD or EBITDA. So one of the frameworks I have in my head is if we're looking at the company with, let's say, EBITDA up to 1 million, and usually the owner is playing a crucial role there and is involved heavily in daily operation. In this case, we probably should consider calculating, doing valuation based on SD. If it's a management team is in place and the EBITDA usually around 1 million or more than $1 million in EBITDA, then we probably should take EBITDA as basis for the calculation. Can you comment on that, please? Thank you.
I think generally that's the right approach to take, and really sort of what your role post-close might be as a purchaser. So if you're buying it as an investment, then EBITDA for sure. So what we try and do in companies of that size, we think that even if their owner is fully sort of operating in the business itself, it's still an investable company. So what we try and do is put a replacement salary for the owner in. So the hypothetical GM can be found for that business for $170,000 a year. So we would deduct that amount from the seller's discretionary earnings, and that would become an adjusted EBITDA, and that would be the basis of our valuation. And once you get into around that sort of $1 million, SDE EBITDA mark, then that's the general approach I think most brokers take. Liz, you're seeing the same thing?
Well, we would look at it, in terms of you as an owner. If you're going to come in and operate that business, what salary do you need to draw? Or if you were going to replace, so we do like to take into consideration, okay, what is EBITDA? How did they arrive at this valuation? And what is SDE? So that we can use SDE and then model your uses for it going forward. So if you're going to work in if the business is, $1 million in SDE and you need to pay yourself, 150, then we're working with an $850,000 EBITDA, and that's got to get modeled into the financing calculation, like how much financing can you get for this to make sure that, with your capital, with your buyer's equity, how much you have to put down on the business and how much you can get from the lender. Does that make sense? Or do you need to find more equity? If you're in agreement with the valuation, you think that's a fair value, that's, part one. But then what can you afford, and how are you accessing capital to afford this company, and how are you pooling together your own capital in combination with the debt to pay for the business at its valuation or what you feel is fair. So it's in combination with what you're able to pay.
And from a straight valuation perspective, I think that that using the sort of you can find sort of management comp data, that's what we generally try and use as a sort of a replacement value for an owner, and that helps with the valuation. But to Liz's point, it doesn't really help the purchaser all that much if we think we can replace the owner for $120,000 a year and the purchaser needs $250,000 a year. I don't think it changes the value of the business, sort of in general, but it'll change the value for that particular owner. Yeah. Everything is specific to the parties involved.
Yeah. And we see both of those spectrums. We see people who are like, I've done well, I don't need to take, Keith might model it as, $170,000 salary, but a buyer coming in might go, well, I've had a previous exit, like I don't need a living wage. I'm just going to crush this debt. And I get to take that 170,000 that they've modeled in, and I'm going to put that all toward my debt servicing because I can. But then we've got other buyers who come in that are supporting, they're the breadwinner of the family and they've got 3 kids to support and they're leaving oil and gas and they need to pull a $200,000 salary. And that business looks very different from one buyer to another based on their personal needs in some instances.
Yeah, exactly that. So Paul, did that answer your question?
Yes, thank you very much, guys.
Appreciate
Thank
that.
you very much, Paul.
Brianne, was there another question in the group?
Yes. Edgara, I'm sorry, Ed, I'm going to mispronounce your name. I'm going to invite you in here. Please also tell us how to pronounce your name once you're in.
You're on mute, Edgaras. Ed. We're going to go with Ed. You can just, I think you can switch over to the next slide there as well. As we're... Well, we wait for, there's something happening.
Yeah.
Oh, there we go.
For a moment.
Yeah. You're muted, Ed.
Can you use the chat now that you're in? You might be able to put your question in the chat.
Yeah, as we're waiting for that. Oh, there we go.
There we go.
Good. Yeah, so the next part of the valuation model, I guess, or the business valuation is where the rubber hits the road. Does the deal work? And this is where we kind of get into the financing component. Oh, there's no button for unmute. Weird. Okay.
Let's see if I can do it. Oh, I can't.
Well, that's funny. Can you put your question in the chat, Ed?
Yeah.
There we go. Yes, this is a bit of a precursor to financing where the rubber hits the road. It's, does the deal pencil? And that's what that means in general is, can you get the return that you're looking for with the equity that you have, with the bank debt that's available to you? And if all of those 3 things are possible, then the deal pencils. So to Liz's point earlier, if you need a $250,000 salary and the business only has, $500,000 of earnings, and you're trying to apply, you're trying to get $1.5 million, it's not going to pencil from the financing point of view. The debt service is going to overload the earnings of the company after you take your salary out and pay taxes. So that's it's kind of an interesting point. We don't talk about it. Oh, there's Ed again. Having still in trouble there. Yeah, sorry, I lost my train of thought there for a second. But Liz, is that sort of how you're thinking about things? Like, everything else said and done, is this going to work for my buyer? This is the approach you take?
Yeah, that's exactly it. And you mentioned taxes as well. Like, the EBITDA is taken before taxes. So we have to put taxes back in. And so, and depending on how much you're borrowing from a bank, we take that into consideration. So, the EBITDA and normalize EBITDA, and this can be challenging too, because if the business did well in the previous 12 months, but it didn't the years before that, then you can't necessarily just rely on the most recent year of EBITDA. So we kind of have to look forward, and we're predicting, what is normal going forward? What can we confidently and comfortably rely on that this company is generating? And then where do we need to use it? So that figure needs to cover, the buyer's wage, or if they're going to hire another manager, that wage, it needs to cover the loan payments from the bank with a buffer. So the banks want to see, it's called the debt service coverage ratio. If you've never heard that term, we recommend Googling it and getting familiar, but the banks want to see a minimum debt service coverage ratio of 1.25. So they want to see enough money on an annual basis to cover the loan payments plus a quarter turn at minimum. So there needs to be enough of a buffer there. And then your capital expenditures, if they haven't been modeled in, you want to know, what are your maintenance costs if they haven't been accounted for, and then taxes, and then your growth capital. So depending on what, maybe your normalized EBITDA is different than the seller's, and we're trying to get you to a degree of comfort where you feel confident in the calculations that you're running, and then that's how we help you build your offer that ties into how you guys have valued it. And maybe we're on the same page and maybe we're not, but that's all part of the fun.
Exactly. Yeah, it really sort of speaks to cash flow versus EBITDA versus net operating income. All of those things mean close to the same thing, but different enough that it probably warrants a bit of a discussion around that. So net operating income is more of a real estate kind of term that's used, but ultimately it's the free cash flow of the business, how much money that business sort of generates every month after paying all your expenses, including taxes. And your EBITDA removes taxes, removes amortization, removes interest on long-term debt. So it's a great for comparing businesses to other businesses because of different jurisdictions. But at the end of the day, EBITDA is not cash flow. And I think buyers really need to understand that. And then when it comes to cash flow, even versus net operating income, I think it's important to talk about how sort of net profit doesn't equal cash flow in some cases. Like if you have a retail store where you're getting cash in the same day, then cash flow and EBITDA are roughly the same. But we just looked at one recently where it's the company that we're looking at does a lot of work for insurance firms. So their cash flow, the business makes I can't remember the number, but say $1.5 million a year, or probably a little more than that. But they needed $4.5 million of working capital because the payments are so slow. So that their EBITDA is truly whatever the number is. But from a buyer's perspective, you're going to have to come in to buy that $1.5 million EBITDA business. You're going to need somehow another $3 or $4 million of working capital, and it doesn't change the valuation, but it changes how the deal gets done for sure.
Mm-hmm.
Have you seen? I know we talked about this one the other day, Liz, but it's a dramatic example of something that happens in just about every case.
Yeah, I haven't seen working capital to that extent in relation to the size of the business and the enterprise value, but where we run into coverage for working capital will get factored into the purchase price to some degree, but then where we see it being covered is normally when you go for your financing, you've got a term loan to cover the acquisition, and usually they'll give you a credit card, but then they'll also be looking at what do you need for a line of credit, and that is usually, so you're usually getting 3 types of debt is the line of credit. They'll open you a line of credit, and then you'll get your term loan for the actual acquisition itself. And so it is a conversation with the lenders on different businesses of like, okay, what can I get for a line of credit here too, to help manage the cash flow? Because that's what the banks are concerned about too, is like, how are you going to manage cash flow? What does this business need? Can the economics work?
Yeah. And we can probably skip to the next one as well here, but and then another part of business valuation, I guess it's not really that much a part of the actual valuation itself, but again, from a buyer's perspective, what's the return you're going to get on that acquisition that you've made? So the most common deal structure, and Liz, correct me if I'm wrong, but it's basically around 30% buyer equity plus 50 to 70% of of some type of debt financing. And sometimes the buyer equity can be seller financing at the same time for, sort of that use case where there's a 5-year interest only vendor note that the banks will treat as equity. So with all that in place, what you need to do as a purchaser is understand what your required return on invested capital is. So if you're working with like a private equity group, they have very sort of fixed IRRs or essentially returns that they're looking for, and they tend to be in the 33 to 50% range somewhere. Most small business, the return on invested capital is fairly significant because of the risk associated with that. So the example that we put out here is a $1 million purchase with $600K of debt at 5% interest and $400,000 of buyer equity of some capacity in that. And if the business generates $200,000 of cash flow, your return on invested capital is 42% on a pre-tax basis. And is that number suitable for you? And if that number is suitable for you, then it's probably something that you should be looking at as a potential acquisition. So when you're looking at businesses for sale on our website or on BizBuySell or businessesforsale.com, the return on invested capital is a pretty easy calculation to do. So I think everybody should be doing that and using that as sort of a basis for, whether this one is going to meet my investment requirements or my purchasing requirements. And do you guys do returns, Liz, in your work?
Yeah, we'll look at the returns for the purchaser, and then if they have investors as well, then it's important. You're obviously, when you're courting investors, you're also modeling the return to them as well. So which can restrict some of the decisions you're making around which business is actually a fit for you when you're bringing on investors. It kind of, it narrows your investment thesis and about which businesses you can actually consider if you're bringing on investors, because you're guaranteeing them, or you're approximating or estimating the guarantee that or the return you want to be able to provide to them. And in this space, we're seeing like investors are expecting a 25 to 30% return if they're coming in to co-invest. So that's a consideration as well. The structures, like back to your current structures, what we're kind of seeing is the lenders are doing 50 to 75% debt. And so 25 to 50% needs to come from somewhere. And that 25, and usually what we're seeing is 25 to 30% is coming from a combination of the buyer's personal capital, some seller financing, and then if there's still a gap, then there's investors involved. Or if someone's going after a bigger business that's outside of their own means, that they're raising capital from outside investors to make it work.
Is that approach more common now than it seems like I'm seeing more of outside investors coming on small business deals in the last couple of years than I've seen sort of in the previous 15 or 12?
It's growing dramatically, and we predict that there'll be an incredible increase in investor appetite for acquisitions, because just on cost of capital as well is fluctuating, and investors are starting to see investors who previously invested in startups where they were risking capital on startup rates are volatile, and so now that there's more stories and there's more case studies, there's more data around the success of co-investing for small business acquisitions. And now there's reports out. And so word is kind of flowing through the investor community that this is a viable place to park your money for a number of years. And there's more proof now, and there's a lot more support for buyers to know how to go to market and raise capital for these acquisitions. So it's been absolutely fascinating the last couple of years to see more of these vehicles be accessible to first-time business buyers, and it's been fun to kind of learn more about from our position too.
Sorry, Ed Gross is just he raised his hand again, so I'm going to see if he figured out the mute button. You're welcome to join in if... Oh, he wrote a note. Okay, I have a question about a business I'm looking to acquire. Okay, I'm going to read this out, okay?
Okay, let's go.
Hi, everyone. Thanks for setting up this call. I have a few companies that I'm aiming to do an MEP roll-up. I had an inquiry about one of the companies. In previous years, the company's financials have been fluctuating. 21 was 800K, 22 was 1.3 million, 2023 was 450K, 2024 and 2025 are between 5.1 and 5.5 million because of new contracts and investments they made in previous years are beginning to capitalize on it. Revenue ranges between 15 million and 20 million. How would you value a business like that? Any opinions?
I have lots of opinions, Brianne. If I was the broker on this deal, I would be leaning so hard into 2024 and 2025 or TTM. What 2021 at 800K versus 2024 at $5 million, I would remove 2021, remove 2022 and 2023 probably, and with a good understanding of what happened in 2023, it looks like they probably just reinvested tons into marketing or something for growth. And then if you got 2 years of $5 million EBITDA, that's what I would be leaning into. And I don't know what type of industry it is, so I can't really speak to what the market comps might be.
Mhm. Oh,
Electrical.
Mhm.
Oh, electrical? That's interesting. And is that industrial electrical or residential electric? Commercial?
Yeah.
You're gonna be fighting with some big boys for this one, I would say. Yeah, because there is a number of platforms right now that are sort of kind of refocused into away from residential in the I call it home services, but basically in the mechanical services space. So there's a bunch of private equity out there that's looking to buy these ones. So if this is a proprietary deal, fantastic.
Yeah, go for it. Mhm.
Yeah, amazing. If you can get it for 5 times, you're probably crushing it.
Fortunately, we have big pockets.
Yeah. So in a non-competitive situation, I'm guessing between 5 and 7 times. They agreed to 4.
Mhm.
Yeah.
Yeah.
Buy it.
Yeah. I would be looking at it, what's normal, but 2024, has passed. So that's validated. And then I would be asking for interims on that and seeing if they would have an appetite to share some of the risk. Is it going to continue beyond what's the kind of level of management? Is there any risk with the owners leaving or are any of them staying on? Because I would be trying to analyze where's the risk, where could the bottom fall out of this? Like, is the 5.1 to 5.5 sustainable going forward? So what do those contracts look like? And then if they're willing to share any of the risk, how much seller financing can you get from them? Or if it's an earnout that needs to be structured to balance some of that risk as well, to consider those options. And then also to be mitigating yourself, if for some reason any of those contracts are lost, that some of the seller financing, that you'd be protected against paying all of the seller financing if any of those contracts are lost for unforeseeable reasons. Reps and warranty insurance is also something that is coming to market more for these smaller deals. So that might be something else to protect yourself on. But yes, to Keith's point, it seems like a good multiple.
Yeah. Yeah. I will say on the earnout side of things that Morgan, one of our partners at Chinook, just got back from an M&A conference, and KPMG put out there that about 75% of earnouts don't get paid. So from just a data point, I don't know for what reasons they're not getting paid, whether the numbers aren't getting hit or whether the financial acumen of the buyers exceeds that of the sellers, so they're able to manipulate numbers to make it so earnouts are harder to achieve. Not sure what the reason behind that is, but when I see numbers like that, it makes me as a seller's representative for the most times go, I'm not sure if I want to do earnouts, have my clients involved in the earnouts. Big thing that we try and preach all the time is simple deals get done, complicated deals don't. So the more complicated you try and make it, the less likely you're going to get across the finish line.
Yeah, in my experience, the brokers and the lawyers don't really like earnouts. But where we see them usually get introduced is normally like if there's in due diligence, if something has been unveiled and there's no other way to resolve it, and it's like, ooh, this is really risky. Let's structure an earnout. But yeah, we have actually a webinar next week on earnouts and all the spiciness that gets involved in there. So yeah, if Morgan's free, he should come on with us.
For sure.
Thank you. Ed says thank you very much. And thank you, Ed, for your question.
So it looks like we've got a couple of raised hands. Do you want to maybe we can just sort of scroll through to the sort of live deal that Liz can look at real quickly and sort of give some thoughts on that?
Sure. Oops.
Yeah. Market value. Yeah. Market decides. At the end of the day, the market's going to tell you if you're priced right or wrong.
Do you want me to go right to this?
Yeah, just go right to that, I think. And then we've got a couple of people with their hands up that we can probably try and. Is that not popping up?
I'm going to get it.
Hit exactly the right spot.
Yeah.
So I'll just walk through this really quickly with everybody. This is a specialized construction firm that our firm is representing. You can see in the sort of highlight section here, the weighted revenue, the weighted adjusted EBITDA, the asset value, and the working capital. And then we can just scroll down a little bit. So we won't have to read it all that closely, but basically it's a specialized construction company. It's project based, been around since 85 or something like that. Owner is retiring. You can further, they don't actually have a real office. They've just got a yard. They got a great team. There is tons of opportunities for expansion. This company literally doesn't it's the ETA dream. Retiring owner, no website, never done any marketing, all word of mouth and relationships that he's built over the years. So I think this is what Liz likes about what we do is we sort of show how the sausage is made for the most part on most of our deals. So 5 years of summary of financial information, adjusted EBITDA, how we weighted that is part of how we do everything. So you can see exactly how we got there. And then what our multiple is as the weighted as a function of the weighted average EBITDA. So Liz, I know you've had time to take a quick look at this one before. What's your thoughts?
Couple thoughts. I was wondering where the SDE was, because in our model, we would want to model in what our buyer's salary needs to be. So I was curious about that.
We've sort of decided not to put SDE and EBITDA both on all of our listings now. It's too confusing for folks. So we think this is an investable company. The owner has been sort of not actively involved for about a year and a half or 2 years now.
Okay.
Yeah, so that's a true EBITDA. So if somebody wants to come in and pay themselves a wage, they totally can. They wouldn't have to. Essentially, there's a general manager that does everything.
Okay.
Yeah. So this is an investable company.
Okay, interesting. Okay. The other thing that I just wasn't a huge fan on was that they do one project at a time. So
yeah.
How many projects after that one do they have lined up after that one? That was.
Yeah, it's a great question. We didn't really sort of address it in the advertising because it changes a little bit over time. So they do have their full 2025 booked out right now, and that's so we say they do one at a time, but they start one and then they've got one or two that they're finishing as they're starting the next one.
Okay.
Yeah, so they have one main project at a time, and each project takes between sort of 4 to 6 months or 4 to 8 months, depending on the size. So some years they'll do 3, some years they'll do 1.5. But it is very project based. We think that their TAM in the Victoria market is probably 1 or 2%. So there's tons of opportunity for growth.
Gotcha. Gotcha. Yeah, when I ran our model, I put in, an estimate of 1.6 million for debt. So, it's just over 700,000 that needs to be made up from the rest of the pie. So, it depends if we were to offer asking price on it. If we offered asking price, which the multiple seemed fair, it was, I think you guys modeled, 3.7 and around that. We would want to know how many other buyers are at the table on this, Keith, and who are we dealing with? Do we have private equity at the table with us, or how competitive
After
is
this call, we will, Liz.
What's that? There always will be.
Maybe after this call, I'm not sure. We'll see.
Do you guys want to
No.
jump in on the last couple of questions here before people have
Yeah.
to get back from lunch, and then we can finish up?
Sounds good.
That's good.
Okay, Marcy, I'm gonna add you in here, so just don't forget to unmute before you ask your question.
Hi there. Can you see me? I think I'm unmuted.
Yeah.
Marcy.
Great. Hi. Yeah, just a bit of a question, two questions, but I'll just maybe do one because I know we're going out of time. But in terms of a business that has, in the wellness sector, that has significant cash flow, I mean, cash coming in the door, but it is counted as liabilities because it is, gift card or future. I mean, just talking about looking at some of the common structures. How does the liabilities, we're talking cash, but in the financial statements, when something's listed as a liability, even though it's cash that has come in the door, how does that factor in when you're working with both buyers and sellers?
So I think there might be two different questions here. So gift cards are one liability, and then unearned revenue outside of gift cards is another liability. So if we're talking gift cards, typically your accountant will say that you've got to, gift cards have sort of a everlasting life, like they never die. They're always on your books as a liability, right? So over the years, what happens is that gift card liability tends to accumulate if your accountant's doing the job correctly. So, over 10 years, the gift card liability might say, for easy numbers, $100,000. And so in a typical cash-free, debt-free structure, the seller would have to sort of give you $100,000 to cover the value of the gift cards. That's the straight accountant kind of approach that they would take. The more realistic approach is that you sort of get an idea of what amount of gift cards get redeemed each year and how much you can write off. So typically you'll discount the value of the gift cards to a certain percentage. So all gift cards issued in 2024 will apply 100% value on those ones because they're pretty they might get redeemed. But gift cards that were issued in 2017, we can apply a value of 0 to those ones. So anybody that has a gift card from 2017 has long forgotten about it. So somewhere in the middle, it's a bit of an arm wrestle, I would say, in most situations.
For my situation, I'm buying a business right now, and I have a vendor loan that I'm paying back. And so what we've agreed on is anything purchased before the date that I switch over and transition in, he's responsible for, and that amount comes off the vendor loan that I pay back. So again, it can be done multiple different ways, but
And in Brianne's case, the seller has got some amazing record keeping. So he knows what each gift card's got a number, knows when it was sold. And so every time that somebody comes in with a gift card that was purchased pre-acquisition, then Brianne just keeps track and then deducts that off the vendor note that's owed at the end of every year on this particular deal. Does that help?
Yeah, that's I'm glad to hear that there are creative ways to figure out this without it just being fully a debt that comes off the sale price. So thank you.
Sellers have a hard time with that. Yeah.
Yeah. Okay.
And
do we have
did
one
you have another question?
I did. In the same wellness space or in any industry, sometimes there are sort of like the hot new thing, or a business that's got a standalone that's really working and it's very franchisable. In your slides, is that like the intangible value, the future value of being able to franchise a going concern business, or maybe again, I don't have a specific question, but I'm just wondering, like, for example, let's take Nordic spas right now, hot, cold plunge, really sexy, vibrant space, but lots of future growth. Maybe the EBITDA doesn't match up with what's potential for a spa to be franchised. Anyway, I'm going deep, but maybe.
I've got tons of thoughts on franchises, but Liz, you might want to go first on this.
Yeah, well, in a nutshell, like if it hasn't been franchised and realized, then I wouldn't pay for the prospect that, oh, it could be franchised someday. I wouldn't pay for that. Like franchising is a whole other beast and comes with a whole other bottle of risk. There's lots of people that feel their businesses could be franchisable, but if they haven't done it, I wouldn't pay for it.
Yeah, I'm with Liz. Absolutely zero value in that. And I will say that probably the riskiest space is to be a new franchisor. The failure rate for new franchisor is 95%.
Wow.
Like it
Higher
is
than I
brutal.
thought.
Yeah, it's very, very difficult to become a successful franchisor.
And the investment to get there is massive.
Yeah,
Substantial.
you're $75,000 before you get out of the chair in the morning to get a franchise disclosure document together.
Yeah. Oh, thank you. Okay.
Yeah.
Thank you so much, Marcy.
Thanks, Marcy.
Great questions.
All right.
So
Sorry, last one, Ted. We got one more question. Do you guys have time for one more?
Sure.
All right, Ted, I'm going to let you in. Don't forget to unmute.
Hi guys, thanks for your
Okay.
time. Yeah, my question is, I see businesses that come in quite routinely that have a real estate component to it, and the valuation on that sometimes has some tricky aspects. If the business isn't making enough money to support the real estate aspect, do you guys have any thoughts on that and ways of bridging those gaps?
Liz, do you want to go first on this one, or do you want me to take it?
Sorry, I missed the first part of the question. Maybe you go first, Keith.
Yeah, so Ted was asking if sometimes real estate that's as part of a business transaction is tricky. So what our approach always is to remove the real estate from the business, like, not remove it physically, but conceptually, make sure that make sure that the business is adjusted to be, the earnings are adjusted to meet market rent for that particular area. And so you can get market rent from realtors, or you can get an appraisal done. But once that's removed, that becomes your real net income or your operating income or your EBITDA. And if you want to buy and so that may or may not change the business value. And then once you have that business value, then real estate is essentially got sort of its own intrinsic value. And then you can buy that separately if it makes sense, or just keep on leasing if that makes sense. But that's how we approach it anyway. And I guess the good aspects of having real estate as part of the transaction, especially if you're dealing with BDC in particular, is that they'll do sort of a combined 90% loan to value on a real estate business acquisition opportunity. So you're paying over 20 years instead of over 5 years, or moving some of the business value into the real estate side of it. Are you seeing that, Liz?
Yeah. So it kind of starts out looking at them as two valuations, two transactions. And then when you get to the debt financing part is like, then you can find a lender that will be a little bit creative. And yeah, if you can, because of the real estate, now you can sometimes extend that amortization period. And Keith mentioned it, like on a straight, business acquisition term loan, it's usually 5 to 7 years, whereas the real estate is 20 plus. So there can be advantages to doing both at the same time. But certainly, normalizing the cash flow for that market rent is part of the evaluation.
Perfect. Well, we're late, so I'll leave it there. Thanks very much, guys.
Thanks,
No worries.
Ted.
So I think that, oh, sorry, I guess we haven't quite finished sort of looking at this particular deal, but I feel like Liz has said this is a great deal and all you buyers should buy it. Is that what I heard?
It's I think the asking price is fair, and I'd say if you're looking at this deal, dig in and do some deeper evaluation, but it's certainly not one to overlook.
And if you're a buyer and you want to work with Liz, we're more than happy to work with Liz and any of her clients on any of our deals.
Yeah.
Okay, we will wrap up. I just want to say thank you for those of you that are still left on the call. Really appreciate you staying the full time. Make sure that you register for the next one, the financing one. It's going to come next Thursday at 12 p.m. And we look forward to seeing you then. Thanks so much, everybody.
Thank you.
Thanks, guys.